Hi, today we are going to cover the following. Why to invest in stock market, what is compounding, what is the difference between active mutual fund, index fund, ETFs and stocks, how to get started, what is diversification. This is Karthikeyan Gopi. Welcome to my channel on personal finance and investing. Let's dive in. Why you should invest in stock market. Everybody wants to get rich, right? You can do that in many ways. You can rob a bank, you can start an MLM company, or you can open an ashram or some kind of cult and so on. But I'm not an expert on those areas. You need to consult someone else. There are just two ways to get rich legally and ethically. That is starting your own business or investing your money. It's not everyone's cup of tea to start a business. We may not be the next Steve Jobs or Elon Musk or even the biryani shop owner in your street. With proper financial discipline and investing skills, you can become next Warren Buffett in your area or at least in your family. When it comes to investing, there is fixed deposit, recurring deposit, post office saving schemes, real estate, gold, stock, bonds and so on. So if you ask me, I would say you can park 40 to 60% of your investment amount in stocks. Why? For that, you need to understand the power of compounding. Say someone is giving you two options. Option 1, you can get 5 crore rupees today. Or option 2, you can get 1 rupee today, but every day they are gonna double it. Say today they give you 1 rupee, tomorrow it's gonna be 2 rupees, day after tomorrow it's gonna be 4 rupees. So it continues for 30 days. So what option you will pick? Either 5 crore today or 1 rupee, it doubles every day. If you have picked option 1, then at the end of 30 days, you will have just 5 crores in your account. Whereas if you picked option 2, at the end of 30 days, you will have 53 crores. You don't believe me, right? You can see the calculations here. Say you have invested in a company called X. 1000 rupees. Okay, so the company does business, makes a profit of 15%. So at the end of year 1, you will have 1150 rupees. The next year, say the company grows in the same percent, 15%. So at the end of second year, your initial investment of 1000 rupees would have made another 150 rupees, whereas the profit from the previous year 150 would have made 22 rupees 50 paise. So at the end of second year, you will have a total of 1322 rupees 50 paise. So invest regularly and let the compounding effect do the job. But how do we, invest in stocks? First, let's look at mutual fund. Stock investing is risky. You should know what you're doing. First, you should invest time and learn about the market, learn fundamental analysis, technical analysis, etc. Say this is very overwhelming for you. Then you can start with mutual funds. Whatever fund you choose, there will be a guy called fund manager who takes all the investment decisions on your behalf. Say what stock to buy, when to sell, etc. We need to pay the expense of this mutual fund house. Say the fund manager salary, advertisement, operational and maintenance cost. We don't need to pay them directly. What they do is, like, from your investment amount, they take a small percentage as expense ratio for these kind of profits and the fund manager salary, etc. Okay, so there is a cap to it. They cannot charge more than 2.5% as expense ratio. Like stocks, there are so many mutual funds available. If you don't know what fund to pick, then you can consult someone called as investment advisor. This investment advisor will sit with you, will analyze your financial goal and give you the right mutual fund to pick. Okay, but there is a catch. Based on how you invest, the mutual fund falls in two plans. One is a direct plan, other one is a regular plan. Say you go to a mutual fund's website, you check the fund, you check all the returns and everything, you do your due diligence, study, etc. and then you invest directly from their website. This is called direct plan. So for which the expense ratio will be lower. In case, instead of this, you go via an investment advisor, you go via a third party, you choose a plan via them, then it is called regular plan. In this case, for the same fund, the expense ratio will be higher. If you want the cheapest expense ratio with a good solid return, then you can go for index fund. indexes, you would have probably heard of Nifty 50 and Sensex, right? Nifty 50 is nothing but India's top 50 largest companies listed. Okay, so investing blindly in an index is called index investing. If a fund manager actively looks for good stocks, buy and sell them to make profit, it is called active mutual funds. If a fund manager just replicate what is there in the index, it is called passive mutual funds. Always passive mutual funds will have very less expense ratio than the active mutual funds. Say you are investing for long run, 10 years or above, then investing in an index fund makes more sense. So most of the active mutual funds over the long run, they cannot beat index. So if you are planning for long run, always invest in index funds. Apart from expense ratio, you need to know entry load and exit load. Say you want to invest 1 lakh in a mutual fund, then you are supposed to pay 0.005% of it as an entry load, which would be 5 rupees per lakh. Okay, so in case you want to take the money out within 1 year of investing in a mutual fund, then you need to pay something called as exit load, which would be 1%. So 1% of 1 lakh would be 1000 rupees. If you are planning to take the investment within a year, you are supposed to pay 1000 rupees. If you are planning to take it after a year, then the exit load will be nil. You don't need to pay anything. There is another type of index investing in which you can avoid this exit load. Like stocks, index funds are also available in the market, wherein you can buy and sell them from the market directly instead of a mutual fund house. This is called ETF or exchange traded fund. For beginners, it is better to invest in exchange traded funds than any other mutual funds or stocks. However, direct stock investment would give you better return. To get started, you need a Demat account to buy and sell stocks. There are many discount brokers available, but I would prefer Zerodha. Why I prefer Zerodha is a topic for another video. To get started, I have added the link in the description. Next step would be analyzing the stocks. Knowing what stock to buy is called fundamental analysis. Knowing when to buy that stock is called technical analysis. Before we get there, we need to cover few other points. First one would be diversification. Imagine you live in the year 1700s, okay, so you have some amount, you want to go to a place for which you are planning to buy a horse, okay. So option 1, you can buy this horse which you think is really good, it is one of the best breed available, it runs faster when the seller shows you it is in a perfect good healthy condition, okay. Option 2, you can buy 4 horse comparatively more or less similar breeds, they are also healthy, runs good, it comes along with the chariot. Say you chose option 1. The horse might be good, it might take you to the destination as per your planned number of days, but there is some risk involved. What if the horse gets sick? Then you need to walk the rest of your way because you have poured all your money into that one horse. In case of option 2, you have 4 horses. In case 1 or 2 fall sick and run slowly, the other horses will run faster, match up the speed and take you to your destination. Here, the horses are stocks and the final destination is your financial goal. Say you put all your money in company X. What if something goes wrong? Say you buy 2 or 3 companies from the same industry, say automobile, and what if something bad happens like a semiconductor shortage? It is always better to diversify your money and invest across stocks and across industries. There is no general rule of thumb here, but it is preferable always invest 3 to 10 stocks and not more than 25 to 30% of your money in the same industry. Second, know Mr. Market. There is this frictional guy called Mr. Market. He owns a piece of land which you want to buy it from him. Say you go and meet him in the morning. He is very happy in the morning. You ask him what is the price of this land. He is saying 10 lakhs. Again you go and ask him in the evening. In the evening he is very sad and he is willing to sell the same piece of land for 3 lakhs rupees. So does it mean the land value increased and decreased within one day? No. The actual value of the land remains unchanged. The price alone varied according to the mood of Mr. Market. Stock market is very similar. Say there is a really good company whose stock value is 1000 rupees. When the market is too happy, you can find the price of the stock at 1300, 1600, etc. Same stock, when the market is unhappy, you can find it for 700 or 800. But remember, always market will correct itself and come back to the intrinsic value. To make money, always buy when the market is sad and sell when the market is happy. Third, know the business in which you are investing. Say you are a computer science engineer and you are working in IT. Okay, so you will at least have an idea what is artificial intelligence, machine learning, etc. and you know what is a buzz happening in your industry. Say you don't know anything about pharmaceutical sector, but you are very confident about this one pharma stock and invested heavily in this stock. Vice versa, there is a biomedical engineer who knows nothing about IT and invested heavily in an IT stock. Say after you buy the stock, some news came in and the stock price is falling crazy. Okay, so now you will have no idea whether to keep it or sell it at loss. Always invest in business that you know or know the business and then invest. That's it for today. This is part 1 on how to invest in stocks for beginners. So in next video, we will see how to analyze a stock using fundamental analysis. Subscribe to this channel so that you don't miss out this series. Like and share this video if you find it useful. To summarize, know the power of compounding. Mutual fund direct plan is cheaper than the regular plan. No active fund can beat passive or index fund in long run. If you are a beginner, always invest in exchange traded index funds. Don't put all your money in one stock or one industry. Diversify. Price will vary according to market mood. Value matters. Invest in business you know or know the business, then invest.